Hey everyone, this is Kirk here again at optionalpha.com where we show you guys how to make smarter trades. And tonight we're actually going to go over all of the trades that we made for today, Tuesday, October 14th, as well as cover again the trades that we made on Monday, the 13th. So I did actually do that video and I know that the email went out, but YouTube did not fully process that video. So I'm just going to cover those trades again here tonight, and it'll be just a little bit longer video because we've got so much stuff to go through, and obviously the markets have been going pretty crazy. So we're going to get into our opening trades, both the ones that are tagged for Monday. So these trades are trades we made on Monday, and then also the closing trades and any adjustment trades that we had. So again, bear with us. It's going to be a little bit longer video. One of the things I'll tell you guys even before we get into this is that I was talking with another member today via email, and I've gotten so many emails from people just asking questions, which is great. And of course, I welcome all the emails. Bring them on. This is what I'm here for, to help and hopefully help guide you guys in the right direction as far as how trading goes. But it's times like these, I think that for me as an educator, people, or I see that people really take note of the things I've been saying for months and months. And so members that have been with us for 2 or 3 months are now starting to realize why I keep harping on, making your trade size small, sticking with the probabilities, having a lot of capital, in your account to manage positions like this, and also add to positions that, are good positions like the VIX and the VXX that we keep adding to. And so a lot of these things are starting to come to fruition now because we're not in a market where, we see the S&P go up 3 ticks every day, right? And it's just steady eddy. It just keeps going up by 3 ticks. Now we've got tons of volatility. Everything's all over the place. And this is when most traders are going to start ripping out their hairs. So I just want to encourage you guys to stick with it. Know that over time, probabilities do work themselves out. Markets are cyclical. They don't go straight up and they don't go straight down. So just stick with it. Know that what you're doing is right as long as you keep your position size small and your trade size small. Don't do things that you don't understand, obviously. So just because we do them doesn't mean that you should do them as well if you don't understand the trade. That's why we have so many video tutorials to help get you over that hump first before you start making some of these trades and start mimicking what we do here. Okay, so let's kick it off and talk about our 2 earnings trades. So we had on Monday 2 earnings trades that we entered. We were trying to enter a couple more, but just didn't get into those. And as far as pricing, we didn't get the pricing that we wanted. Again, with earnings trades, because we're trying to focus in on that implied volatility drop right after the one-time event, so right after earnings are announced, what we want to do here is sell strangles. So strangles are naked on either end. You can do an iron condor if you want to. If this is an IRA or a retirement account that you want to do these on, but you're not going to have as high of a probability of success because you have to buy that extra leg, right? So if you can do a strangle, that's ideal. In both situations for JP Morgan and Johnson & Johnson, what we did is sold a wide strangle, the 61 call on JP Morgan, the 55 put, and on J&J we sold the 103 call and the 95 put. So in both cases, try to take it very wide, but still collecting a fairly decent premium. So JP Morgan a little bit less at about $32, and Johnson & Johnson we were able to collect a little bit more, about $76. Now before I go to the chart, I'll just quickly show you that we bought both of those back today at profits. So both JP Morgan and Johnson & Johnson, we both bought those back today at nice little profits. Not as much as we usually see on some of these earnings trades because we didn't see the big drop in implied volatility. There was a little bit of a drop in each, but not a huge drop that we usually see just because the overall markets were still very volatile. And actually what we ended up doing was adjusting Johnson & Johnson just a little bit, so it turned a small profit in there today after our quick little adjustment after the earnings were announced. But let's go to the chart here of JP Morgan, and let's go over this one first, and then we'll hit Johnson & Johnson. So you can see here that we did get a little bit of a drop in IV, so implied volatility did drop after earnings, and you'll notice it fell right within our range. So our lower kind of range here was at 55. It wasn't even close to that. It settled nicely inside this range. Now we could have obviously held this position for the next couple days, but again, that wasn't the trade that we were making. So the whole goal of this was to take advantage of the drop in IV, the one-time binary event that happens around earnings, So I usually like to get out of these trades if they're profitable. In this case, it definitely was, and it's not worth holding for another 3 days just to see a wild swing in this stock as we head towards expiration. But you'll notice that we didn't get the full drop that we were really looking for. So if IV had really, kind of tanked, we would have seen a much larger profit much quicker in JP Morgan. Johnson & Johnson is pretty much the same thing, only that it really kind of tested us to the lower boundary here today. So kind of dip below that lower strike, and you can see little drop in implied volatility, but overall it went from about 100 down to the 90th percentile, and you can see that definitely tested us to the bottom side. So that's why we made a little bit less money in Johnson & Johnson, but still overall, even though the stock went, kind of against us and made a huge move, it's down almost 2.5% today, that even though it had that move, we were able to make money because we were on the right side of volatility, which is really key. Okay, and I'm going to jump around here just a little bit because I want to make sure that we stick on this earnings subject and this earnings topic. I don't know how that got moved over. So the other earnings trade that we did enter today, which is Tuesday, is this strangle in INTC, which is Intel. So we actually had a couple other trades that we were trying to get into, but Intel by far was the most liquid. It seemed like it had the most, options that were being traded and gave us the best pricing as we went further out. So I want to go over this one in detail with you guys on the trade tab, but you can see that we went ahead and sold the October monthlies, which only have 3 days left, the 34 calls and the 34 puts, so very even distribution over the market, and we sold them for around 40 cents each as far as a credit. So when we go to Intel here, and I just want to use the trade tab because we don't even need to see the chart, it's just a one-time event. You can see that Intel is currently trading about 32, so we're very evenly spaced above and below the market. And what we tried to do was focus on the probability level on each end being equal. So again, we wanted to make things as equal as possible. And let me just go here to probability of in the money. So on the top side with our calls, we were focusing around the 15% probability level, which is the 34 calls. So we sold those. The bottom side, same thing, around the 15-16% probability level, which was the 30 puts. Okay, so that's why we chose those strikes. If you were more conservative, you could have gone out further, but you'll notice you start really dropping off here as far as premium you collect the further out you go from these strikes. So the market doesn't really anticipate a big move higher, and that's why those options aren't being valued as much. So they're still not too expensive options right now. They're $19, $18 a piece. So it still gives us a little bit of premium, being just far enough out of the one standard deviation move in Intel. Okay, so going back to trades that we made on Monday. So we went ahead and added to our VIX position both on Monday with some extra call spreads above the market, and today as well with a VXX call spread above VXX, which is a VIX ETF. And so both of these positions, again, like I talked about in the beginning of the video, are meant really to take advantage of kind of the situation that we're in with the market. High implied volatility. We've got to, kind of double down on being bearish on implied volatility because over time it will go down. And for these positions, they're all the way out in November. So even if they don't make money in the next 2 weeks or 3 weeks, we've got plenty of time between now and November expiration for these things to really come in. With VXX, we were able to go all the way out to 45, which is pretty incredible because VXX really hasn't been at these levels for about the last 6 or 7 months. So let me actually drop the IV on the bottom here so you can just see the chart. And you can see back in August, we had a little bit of a pop here, made some money. We traded VXX then as well. And now with VXX here, we were able to sell options all the way back out at 45. So this is the level that we need to see VXX trade above and close above by this date, which is November expiration. So you can see that every time VXX trades higher, it just gets crushed lower. And even, back here when it was starting at 42 and went all the way up to 56, and then ended that same month, not the next month, at about 42. So I feel really good about this trade because we're starting here at 38 We've got a huge move to go up and close above that level. That means that there's got to be extreme volatility in the market, and it's got to stay around for a long time. So again, really like this trade, and you're only able to make this trade if you've done things and kept yourself small along the way. And you can see that these positions are starting to get a little bit bigger as far as contract size because they are a little bit more high probability trades. So we're going to focus on those and be a little bit more aggressive in them. Another trade that we entered today early in the day is our Iron Condor in Halliburton. So Halliburton's an interesting one. It does have earnings coming up, but really you really can't, move away from the fact that it's got 100% implied volatility. It's been one of the hardest hit stocks out there. So what we did with this Iron Condor is try to take in a lot of premiums. We took in a 94-cent credit on a $2.50 wide spread on either end. Okay, so a very large credit, and that hopefully is going to help kind of, protect our position. And we definitely tilted it a little bullish because, again, we think that the move down is obviously huge, has to be respected, but at some point it's got to come back to a normal range. That means that Halliburton's got to start trading higher, sometime between now and November expiration. So logistically, what we did is sold the 60, 62.5 call spread. Also went below the market, sold the 47.5, 45 put spread. Took in a 94-cent credit on this. Kept it small with just one contract since it's a little bit closer to the market. But when you actually see the chart here of Halliburton, you can see that just how violently the stock has moved down. So we've obviously tilted ourselves just a little bit bearish because at some point it's going to make a move higher, and we want to be part of that move higher. So we've kind of adjusted the Iron Condor appropriately to take advantage of possibly a move higher in the stock. All right, so this is what our Iron Condor looks like in Halliburton. You can see that on the top side, we've got a range and a break even that's a little over 60, so that's about where it's at, about 61. On the bottom side, we still have some move lower, so if Halliburton does continue to move lower, it can go down to about 46 before it actually starts really causing some pain. Today, it was trading and closing right at 50, so you'll notice that we gave ourselves a little bit of room to the downside, but most of our windows actually to the top side. So this is just one way that you can, again, use these Iron Condors to shift your perspective on the market and your assumption either up or down depending on where you think it's going to go. So our range right now in Halliburton, because of implied volatility and how much premium we took in, is about 46 to 61. So if I just kind of shrink this down here just a little bit, you can see that this is basically our range, 46 to about 61. This is the range that we would make money between now and November expiration. Again, very much tilted to the bearish side, that's okay, but still fairly neutral. So this is going to be a very neutral position on our portfolio, even though its strike prices are positioned for a bullish move. Okay, the last trade that we want to go over here for opening trades today is our short call spread in WFC. So when a lot of the markets opened up and earnings came out for JP Morgan and Citi and the like, and we didn't see that implied volatility drop as fast as we wanted, we had an idea to go back into the market and take advantage of that, right? Implied volatility hasn't dropped, but we're now past that one-time binary event. So with Wells Fargo, it was one of the worst performing stocks today, and we decided to go ahead and add some negative delta to our portfolio and sold the 52.5 call spread above Wells Fargo for 50 cents. So I think it was a really good trade. We ended up making some good money on it today. You'll notice that Wells Fargo, even though we're now beyond that binary event, still has implied volatility rank in the 98th percentile. So it had a huge move lower today. So we're just going to expect that the stock basically continues lower. Not that we necessarily want it to go lower or believe that it's going to go lower, but we're just playing it to the downside because we need some negative delta in our portfolio just to kind of even things out. So that's one of the ways that we're doing it here today is with selling a call spread in Wells Fargo. Okay, so moving on, we talked about the closing trades that we had in JP Morgan and Johnson & Johnson. So now we've got adjustments that we made. So we'll start off by talking about the adjustments that we made again on Monday this week, since that video did not process at YouTube. We went ahead and with eBay, went ahead and bought back one of our vertical put spreads, basically to start exiting it before October expiration. So we'll kind of wrap up eBay with a lot of the other ones at expiration, but safe to say that we definitely are going to take a little bit of a loss on eBay. Our adjustment did work to reduce our loss, which was great, so thumbs up there. And in this case, by buying back the 55-54 put spread, we actually bought it back at much lower than its theoretical max loss, which would be $1. So we saved some money on this end, and all of this helps to reduce the loss in eBay. Same thing with our vertical in OIH. So went ahead and bought back our 49.46 credit put spread that we had originally sold, bought that back for less than max loss. All right, and then for adjustment trades that we made today, for Johnson & Johnson, like I talked about earlier, we did at some point earlier in the morning went ahead and rolled down our 103 to 99. So this is when Johnson & Johnson was starting to test that lower boundary of our strangle. So we went ahead and rolled down the 103 to 99, took an additional 37 cents in credit, and that did help us because that was really there to help drive the fact that we turned a little bit of a profit in Johnson & Johnson. So I'm glad that we did that adjustment. Could have been a little bit premature, maybe, but it was mechanical. That's exactly what we want to do is, react to the market and don't think too much, just do what we know is going to work. And in this case, rolling that down actually ended up being, a good little trade for us at the end of the day. And then as far as X, what we did today in X, which is our massive strangle in US Steel, is added to the call side. So one of the ways that we're going to try to bite back at the continued movement lower in X is by selling calls above the market and continuing to build that credit so that if it does continue to move down, then we'll have something there. Now, if it moves up, we've got short puts that are still going to make a lot of money back, that is, if X continues or ever does, show some signs of rallying. But in this case, what we did is not roll anything down, but purely added some more short calls to the position. So I want to go over to the Analyze tab here of X so you can see exactly what that looks like. All right, so now we have 9 of the 35 calls, and today we only had about 6, I think, well, what did we add? We added 3 of them. So yeah, so we only had 6 of these. But if I just take this off for a second, you can see that, even if I take off all the 9, so again, it's only 6 that we originally had, so we only added 3, but notice just the rate of descent here, right? So right now, the rate of descent is very, very aggressive to the downside. And by adding those additional short calls, we're starting to flatten out this line. So it's very minimal here, but now you can see that the rate of descent here is much, much less and much, much more flat across the board. So we're starting to pull kind of this side of the trade in. We're starting to pull this side of the trade in, starting to flatten out this side, hopefully by pushing this side up. So the more calls we can sell and the better that those go right now, if X does continue lower, the flatter we can get this curve on the bottom side of our graph, meaning that every dollar that X moves lower, it has less and less of an impact on our portfolio. So that's what we did today. We're a little bit unbalanced now, so we're not completely even with our inverted triangle in X, and that's okay. So we have a lot of 35 calls. We've got a lot of 32 puts, and again, if X does rally up, the 44 and the 46 puts that we're still short from way, way back are still going to make back a lot of their money. All right, and then finally, our last adjustment, and I appreciate everyone sticking with me all the way through this video, is covering XLE. So XLE is a really interesting one. We decided since XLE is moving lower and still has really high implied volatility, we just can't not sit here and make some sort of adjustment to take in more credit. So what we decided to do is add a call side for a credit to this trade. Now what you'll notice is what's a little bit different from this trade is that we went ahead and did the strikes just a little bit wider in this case. And by widening out these strikes above the market, we were able to take in a bigger credit of about 52 cents. So logistically what we did is sold the 88 calls and bought the 92 calls on XLE, so well above the market for a 52-cent credit. Now on the profit loss diagram, let me just go to the XLE diagram here. I'm going to take off these calls first. This is what our short put spread would or did look like before this adjustment. So very general short put spread, but you can see that at the current price of XLE, if it doesn't ever rally back up to around 86, which it obviously could, we'd be losing about $680. So by making this adjustment, selling 4, but just selling them a little bit wider, now we've got kind of this broken wing iron condor here. So now you can see we still have that short put spread in place, but we also now have this call spread above the market. And what that's done is that we pushed down this side of the profit loss diagram. So we've added a little bit risk well above the market, but in return, we get compensated over here, and we've kind of reduced that loss, that max loss that we have in XLE. So we've still got a November trade, so we still want to hold this, see what happens, but worst case, if we don't make any other adjustments, we've now cut our loss from 680 down to 472. So that's really, really helpful, and we can, again, continue to make adjustments to this to cut the loss. But this is the name of the game, right? If the market moves against you and makes a huge move lower, you got to be able to reduce this loss and kind of break it down, and hopefully we can continue to do that, and we get a nice move up in XLE and oil generally, and start to recover some of these trading losses. So I know that was a long video tonight, but again, I really appreciate you guys sticking with me. And as always, if you guys have any questions or comments, please add them right below to this video, and happy trading.